here we are, Tuesday, 28th of July. It's just coming up to 4 p.m. I'm here in Cape Town, up the road, up the N1, 1,000 plus kilometers away. Mitchell Carey in Joburg. How are you doing, Mitch?
Good on you, Pete. How you doing? How's the winter treating you there?
Cold. And yesterday, bloody windy. Windy as hell yesterday. It was really, really tough. But no,
It's
all
so
good this
unusual for
this
Cape Town, eh?
yeah. You know, who would have thought on a coastal environment, wind and a bit cold
Yeah,
on during winter, eh?
it's wind, cold.
Mitch, good to see you again. And it's been a couple of weeks since our last podcast. Again, thanks to all of you who have taken the time to watch the last one that we did, where we talked a bit about some of the sort of investment strategies or lack thereof, or decision making, particularly for young professionals. We talked a bit about, if you remember, Mitch, we talked about the car,
Mhm.
when to buy the car and what to buy and the property, and those are some of the things that I really had looked forward to going into. And thanks again for your insights into that. What has been quite interesting watching you over the last couple of weeks on social media has been a series of posts that you've made on LinkedIn. And I thought today what would be cool, as opposed to going into part of the theory or um, the particular theme, was just to try and pick
Mhm.
your brain. It's clear that you're almost looking at a sort of diarized version, day one, day two, day three. I think this is actually day 14 today, where on a
Yeah.
daily basis you've been posting on LinkedIn. And so I thought, okay, let's just change it up a bit. What are you posting on LinkedIn, and how does that complement and support some of the work that we're doing in relation to the Rands and Cents podcast? But yeah, tell us a bit about what's been on your mind and why you're posting every day now.
Well, so the concept was that I want to take some of the aspects and the detail that I use when I'm doing financial planning um, to and show that there's a process to it. There's lots of different detail that needs to be looked at. And as always, one long post with all that detail, I feel like most people would miss it. So I thought, okay, let me take something that's front of mind for me at the moment because it's what I'm dealing with and what I've dealt with in the past, and break down what I'm thinking when I'm giving advice. Okay. So this came from seeing a post about one of our big banks that expanded too fast, and now they're looking to shrink their headcount and close some of the banks. It was it was probably a prudent move, cutting costs. Not great for the people employed, of course.
Of course,
However,
yeah.
it was a prudent move on their part. But 10 years or so back, I we as a team work with a lot of retired clients,
Mm,
and
mm.
we had clients that went into were enticed by the African bank because of the higher interest rates that they were offering at the
Of
time.
course, of course.
And unfortunately, they put the bulk of their capital that they relied on for income in the bank, and then the bank got into financial trouble. And it took years for that money to come out. Some of the money only came out after 5 years, the capital. So those retired clients who are most vulnerable to losing capital, uh, um, vulnerable to losing income from the loss of their capital, were the most affected. And in their minds, they thought, the bank is safe.
Of
Okay.
course. And I mean, and why not? I mean, it's for so many years, it's what's drilled into us, not so?
That's the thing. It's almost like knowledge. Like we know that if you go to the bank's got you. You don't have to worry. So the idea behind the post was just to say, look, Pete, if you're going to have more than 100,000 rand in the bank, you got to understand. Fortunately, since 2014, we've got a protection where that protection will pay out 100,000 rand of any capital that you have. The balance of that capital that sits in the bank, if a bank um, gets into financial trouble, remember banks are businesses. So if they're badly run, they can quite easily get into trouble. And usually, when businesses run into trouble, we are the last ones to know before things go wrong. So when you're planning um, and you're looking at capital, for instance, an emergency fund, if half a million's kept in the bank and you rely on that money for emergencies like going to the doctor or big medical expenses,
Hospital or yeah, medical costs,
yeah,
etc. Yeah,
oh, you drive through potholes. This is Joburg. We have potholes. I know you guys don't have any.
you do. Should try Cape Town. Not so many.
Yeah, you haven't seen potholes yet. You need to come visit, Pete. So
Yeah,
anyway, going through,
I'm
we've
going to
had
be
it
there next
before.
week for
We
my inspection.
say again, say again.
I'm going to be there next week for my inspection of Joburg
Okay,
Tunnel.
can you come and see those roads of ours, please, and shout at them? We need
Hmm.
proper town planners back. Okay, so so blowing out four tires, and with mags, that's
Yeah.
20 grand,
See, see,
25 grand.
yeah, yeah,
Yeah.
yeah. At least, yeah,
So if we're going to a situation, then you're having an emergency, you don't want your money locked away. It's very
sure.
unlikely in the South African environment because it's such a heavily regulated space, including the insurance companies that we know and mostly like. Um, so the idea was okay. So if you put 100,000 rand, you're good. So keep a
So
hundred
that
thousand rand if you need.
there's a threshold. There's a threshold, right? There's a not the value. This 100K is what you're saying is that if you've got 100K in the bank, no worries. Your money is guaranteed via legislation through the regulations, etc. But beyond that, you may want to think about a diversification in the investment approach that is outside of a banking environment. Is that basically what you're saying, right? That's the summary.
You're hitting the nail on the head.
I
So
wasn't aware of that. I wasn't aware there's a 100K limit or like a fail safe.
unfortunately, from 2014, that came into legislation
Okay.
after I think a long time of lobbying. It is a standard in Western societies where there's a certain amount of money that is guaranteed by the Federal Reserve or whichever
Right.
monetary body governs that society or that economy at least. And South Africa was lagging in that. I think a lot of that was because of the financial stability of our banks through all the years. But then we
Yeah.
started to see cracks coming through over the years. Um, in the American space, I mean, you just need to think Lehman Brothers, the bank that was too big to fail. So that's always in the back of my head. That's always in the back. And walking with those clients when sometimes up to 80% of the capital that they were living on was frozen was a very
Yeah.
difficult thing to watch, and you're helpless. And fortunately, there was a good outcome. The money did eventually come out of the bank. However, it was touch and go for a while. What happens is most of the people enticed by interest rates and unit trusts with high that invest in bonds have very similar interest rates and sometimes most times better than what the bank can offer. And if you understand where to invest in the unit trust, that money can be available to you within 2 to 3 working days. So it's not
Right.
like it's stuck in something. So
Sure.
you've got 500,000 sitting in the unit trust. You need 50 grand. Most times it's in your banking account within 3 to maximum 5 working days.
I guess that's where people have, typically thought about the bank being easily accessible. I mean, we know that you can jump online now and do, transfer between your accounts, credit card, or whatever it might be within seconds. What you're saying is that the flexibility is there, even in products like, for example, the unit trusts. There is a slightly longer waiting period, but again, in terms of that emergency response, it's no longer than a week. That again is the summary that I'm hearing you describe there, and that is A, on the
Mm.
one hand, diversified your portfolio, B, again, spread the risk, I mean, maybe that's worth talking about. So, what are the risks of the unit trusts then? If the
That's
idea is that the
that is
bank
such
has
a
always
good,
been
that's such a good question. So I was thinking about it a lot today because, and I was thinking back to those clients. So low risk, high income unit trusts, we call them income funds or flexible income funds, predominantly invests in government bonds, which is by far your
right.
safest option. So,
Hmm.
people think South African government, oh, actual fact, it's backed by the whole economy. So that's the last thing that's going to fail. Then you have a whole, we have corporate bonds. You've got then parastatal bonds. So a good fund manager, and that's where the difference comes in, is when I'm advising a client and we're going to invest in a unit trust, I know the underlying assets and the risks that are associated. That it's very clear on the fund fact sheets. When we've got a conservative investment, the mandate really matters. So they have to stick to that mandate. And in a nice conservative income fund, you're getting 9 times out of 10 much better interest rates than holding it in the bank. And what they do is then they stick to um, a credit rating of above B plus. Most of the about 50 or 60% of the stuff is in A plus plus bonds in South Africa, and that also means that you invested in multiple banks and multiple government bonds, and anything that is guaranteed by the government, so a parastatal like Eskom, any debt that these guys put into these funds, they guarantee that Eskom will pay that interest or pay back that capital. So that's a very important part of it.
That's really interesting, Mitch, because again, I mean, I don't have Eskom's annual report in front of me. I don't know what the numbers that they brought in, but I mean, Eskom's name at the moment is not a particularly good one in South Africa. If you're saying, invest my money with Eskom, you'd understand there's a natural hesitancy to do that.
Which is
And if
fair.
you want to talk about a risk assessment by the average Joe in the street, say, do you want to put your money into Eskom? I'd be hard pressed to imagine that many people are going to say, yeah, absolutely. But again, I'm trying to understand this. You're saying that that's actually because of the way that things are set up, the regulatory environment. Eskom as a state owned entity is actually a good option in terms of a conservative savings approach. Am I hearing you right there?
You're 100% hearing me right. But there's a difference between government backed Eskom bonds, government backed, did I say that right? Yes,
Hmm.
backed, and non government backed Eskom bonds. So the coupon or the interest that they pay usually indicates the level of risk that you're taking. So if a government bond's giving you 10% and the Eskom's giving you 20%, you need to take a step back and say, okay, why are they paying so high? Because the risk difference of them defaulting is much higher.
So when something is too good to be true, it is too good to be true. So you're factoring in that risk into your assessment. And again, that's something that you as the financial advisor would be looking at and giving that advice, right?
Yeah, so exactly that. So I say when I'm dealing with clients, I always say use me as a sounding board.
Mm,
You often come across scenarios that you deal with once or twice in your life or once a year. I'm dealing with those probably weekly. I'm dealing with
sure.
situations like that. So you'll often see signs when you're driving out or on your Instagram feed or whatever that may be of these fantastical interest rates that people are offering. And you've got to ask yourself, if that was that good, why aren't the banks buying that out? If they can get 15% or 14%, why do they have to advertise? So you got to think, if it's too good to be true, it's most probably too good to be true. Yeah.
And again, I guess I'm differentiating there between a particularly good year where the returns may be really, really good versus something that seems unrealistically high, and that would typically point to risk. And if it goes wrong, then you will be the risk will be higher in terms of the losses. Correct?
You'll be left wanting.
Yeah.
You'll
Okay.
be left wanting.
Mitch, let's go back to your LinkedIn posts. So you, I say you're 14 posts in. What just pick up two or three of the themes that you've been touching on that seem to have sparked some sort of interest or response. Something that A, you enjoyed putting out, B, seemed to get some response from your followers and so forth.
Okay, so the big thing was that prompted it. Like I said, I saw that article on a bank, and it reminded me of that time um, when those clients were stuck. So
Right.
a little with some structured financial planning, it would have changed all of that. So
Mm,
if they had had the bulk of their monies that is available, uh, the amount, a small amount in the bank, and the bulk in the unit trusts, they wouldn't have had that issue. So there's one caveat that I need to raise is that a lot of these unit trusts had a small amount, so like 5% of the total capital in African Bank. So that money was also frozen. But it goes back to not keeping all your eggs in one basket. So they've got a basket of quality bonds, and if 5% fail, it's not catastrophic. So, and that is the essence of not keeping all your eggs in one basket.
help me there.
Question.
5% fail. What do you mean by that?
So, a low risk income fund at the time that African Bank went into distress, a lot of these income funds held African Bank as one of the bonds in their unit trust. So that was stuck for 3 to 5 years, that
Right.
portion of the capital. But 95% was still there earning a good yield to the clients.
Understood. Understood.
So that is not keeping all your eggs in one basket. The alter so that so the build of the feed is understanding how each product works for you, looking at life products like endowments, how it protects you against creditors, how it for high marginal tax rate earners, how it brings down your tax. But that's another thread that I'm going to go through. That's something I really enjoy. Making your investments tax efficient, but this is about protecting your money. Knowing how certain products can protect your money, how products can protect your money against creditors, where unit trust doesn't is not protected against creditors. An endowment structure or retirement annuity is totally protected. However, that protection comes with set rules, so you've got to understand
Sure.
those rules. So that is the essence of building a financial plan. If you're going to have an emergency fund, you need some money that's instantly accessible.
Understood.
However, you don't want your money to get stuck if the bank goes into distress. So you have something that matches the bank risk profile within a unit trust, and then you work your way up the line depending on what your investment targets are, and you use the structures of the underlying products to build your total portfolio and have the protection with the growth and structured within all the different product types.
Mitch, if we play sort of cards on the table again, we haven't really gone into it in much detail in our podcasts, but I mean, ultimately, you're representing Liberty Life as the is your main product and who you represent. Liberty, if I remember correctly, is the word underwritten or is sponsored, whatever the word is, by Standard Bank. Is that correct?
Okay, so Standard Bank owns Liberty Life outright as a business.
So if I was the CEO or the head of banking for Standard Bank, and if we're listening to this and saying, you need to be careful about the banking structure, and keep in mind this 100K threshold that you've alluded to, isn't it also the counter argument of saying, look, the bank still remains your primary solid base, and in fact, if you look at the numbers of failures within South Africa post '94, you can well, you've talked about one instance. Do I remember Perm going through something similar back in the day? I might be wrong.
So all of the United Perm, they were all bought up by the bigger banks.
They were bought. Sorry, they weren't. But so the failure rate is so minimal. I'm
You're
guessing
correct.
that on the one hand, what you're describing in terms of diversification and the eggs in basket that we've talked about week in and week out on the podcast is complexity. And I'm saying, look, I don't need complexity. I need something that is, I know where it is. It's not under the mattress. It's doing what it needs to do, where we've talked about. It's keeping up with the inflation rate and the compounding interest and all those good things we've talked about. Why would I make it more difficult by having these different things? And you've talked about tax efficiencies, maybe one idea, but I'm trying to think about it as if I was the CEO of Standard Bank and saying, "Man, this is a difficult. We want your money. We prefer to get it through Standard Bank than necessarily Liberty." I'm hypothetically. Where do these things begin and end in terms of the advice of saying, bank with us, put all your money into us, the likelihood of us failing is minimal, versus go complex, have a financial advisor who's going to have charges associated with that. And we will go into an episode around the costs, because your advice ultimately comes at a cost.
Fair.
Why? So I'm just trying to not push back. I'm trying to interrogate the complexity and the costing versus the simplicity and a risk margin, which, if we look at historically within South Africa, has been, I would always say, the banking system seems to be the one thing that, when all else is going mad around us in South Africa, potholes and all the good
Mm.
stuff that we can go on for, load shedding and all, the banking system, and well, everyone else failed in 2008. South Africa somehow rode that wave because of some of the protections that have been put in place, Minister Manuel, etc. I think we had a lot to be grateful for. So yeah, I'm just giving a bit of pushback, and I'm putting a CEO hat on that I don't deserve. And I'm saying to you, think of it from that angle. Tell me why I should go complex and with costs associated.
Okay, so the first thing is, when we are looking at investment products, I'm always wary if there's complexity. Usually, complexity hides the underlying cost structures and what it will cost you to have that product that is very complex. A unit trust is, is not complex. It is a basket of shares, bonds, listed property, and so on, both locally and internationally, depending on the mandate. And that is held on your behalf in trust. So, and the rules around how the investments are put together are highly regulated, and they're regulated to protect you. But in terms of complexity, uh, I wouldn't say those are complex products at all. When it starts to come to the life products, there is complexity built into it, mostly from legislation, but the tax benefits that you and the tax efficiencies and the net outcomes. That's why it's worth putting these products together in your portfolio. So like a quick example, if you're getting 10% interest at if you're getting 10% interest at the bank, marginal tax rate is 41%. You are losing 41% of that return per annum. Within the insurance that are available and the structures that are available, you can reduce that amount of interest that you are paying considerably. And that's why those structures make sense for most people that have a marginal tax rate of more than 31% in South Africa, in a nutshell. But there's a lot more detail that matter in that situation.
But I mean, one of the conversations you and I know we've had is, let's say I'm buying 1,000 rands worth of unit trusts. There is an upfront cost. We'll buy those unit trusts, but I'm not going to end up with 1,000 rands worth of unit trusts. There is a cost to buy those as an asset class. Am I correct? Am I remembering that correctly?
Okay, so
That and so that needs to be factored in as almost like a capital purchase.
absolutely. So um, okay, so from my point of view as a financial planner, my existing clients, I don't charge an upfront fee. So if you put 1,000 rand in, you'll get 1,000 rand invested, but there is a fee that is charged per client to cover the hours that are that we work together in that year, and that comes off your investment. The idea though is the net result needs to be better than if you just kept your money in the bank. That's an important part.
100%. And I think that's where, again, these things, and that's why I suspect what we need to do as our next episode is go into some of those, let's call them the hidden costs, or those T's and C's, and the financial element. I mean, ultimately, you're in business to make money and to be able to generate an income from the advice that you give. And I think that would be an important conversation to have. But I just thought that was worth talking about in terms of the unit trusts.
That's
But
fair.
let's talk as we start to bring the episode to a wrap, Mitch. Tell me what you posted today, day 14. What were you talking about? What can people find on LinkedIn about today's post?
So day 14 is a summary um, of my thoughts on the 13 days before that of posting, wrapping it all up. That a large part of financial planning is knowing the detail that matters, okay, and the detail that's going to affect you, good or positively or negatively, and then using that information to structure a portfolio that works on all the different levels. So it protects you, it has accessibility, and you're working down and you structure your portfolio like that. And understanding your full financial plan falls into the detail that I've gone through. So it's touching on the detail. There's a lot more detail to unpack, and that unpacking usually comes sitting with a client and getting to know them over the years, and understanding what will work for that client and what it may work in theory, but actually not for that person.
100%. Well, Mitch, let's call it a day for now. All the best with this sort of diarized approach. Really excited to hear how it unfolds. And I think just in this episode, we've almost identified some of the next episodes that we can cover in terms of the themes. We've talked about the costs, and no doubt some of the responses we'll get will help shape what's to follow. But it's, as always, been great to chat to you. Hugely appreciate your time and your insights, and keep doing what you're doing. And I'll be looking forward to your post tomorrow, day 15.
Fantastic. We can build up to the next podcast there.
There we go. Look forward to that. Enjoy the rest of your day. Stay warm, and
You
a whole week ahead of you still. Look after yourself. Speak to you soon.
too.